Okay, welcome. We're live. We're not singing today, Neil. We aren't.
Wrong thing.
Wrong, exactly. Okay, so welcome everyone. So this session's focused around sort of building towards a high valued exit, and obviously I've had a really good start. Everyone seems to have enjoyed Rob's session this morning, and to me, this has been something that we think about a lot as founders, and it's something that I've been fortunate enough to have conversations with these two gentlemen during WI's time. So going forward, in this discussion, I want to touch on, some of the key areas that I suppose owners, investors, and so forth, because pretty much shareholders have a role in the way in which they work with companies, in that they can give guidance or give suggestions or give ideas to the founders that they're working with. So this session's really around sort of structuring and preparing for that. So as a first point, I'll get Rob to do a bit of an introduction to himself, and then I'll get Neil to give a bit of an introduction to himself.
Easy. Is this on? Yep. Rob Antulov, managing partner for Modus Partners in Australia. Modus Partners is a tech-focused corporate advisory boutique, a small office in Sydney and a small office in Singapore. And we basically serve the Australian and Southeast Asian markets. But we have clients typically from those markets, but with investment or acquisition partners from anywhere around the world. I've been doing corporate advisory for about 15 years or so. Prior to that, I ran a tech startup. Prior to that was my last corporate role. I was head of strategy and M&A at Fairfax. And I've got a sort of a tech background. So the majority of my career has been in technology, and the bulk of, or in fact, all of the advisory work that I do now is in tech or media. And typically the transactions we work on are in the $5 to $50 million range. So.
Thank you, Rob. So I'm also Neil Bourne from Eaton Square. We're also a corporate advisory group. We specialize, I guess, in companies in the sort of $10 to $200 million enterprise value layer. We have a strong emphasis on cross-border transactions. So we have partners in our group in America, Canada, Europe, and across Asia. My interests are also technology. I've been doing corporate advisory, either raising money or selling tech companies for about 20 years. Prior to that, I was at a venture capital firm. Prior to that, first career, I'm an electronic engineer and worked in techie roles in IT before my MBA.
Perfect. So one thing that was discussed earlier today, which I thought was really interesting, because in the capital raising area, we find that 80% of the companies that we deal with don't have typically an advisor attached to them. Often they're doing their own capital raise. And in Rob's session earlier, he mentioned that one of the things that if he's looking to buy a business, he likes sort of dealing with an advisor. So I'll kick off with you, Rob. You've worked with over sort of 70 different companies. What are the common mistakes that founders and entrepreneurs make when planning an exit, and how can they be avoided?
I think the key mistake that's made is that the planning and the preparation phase commences too late. I think entrepreneurs who are looking to exit or potentially looking to raise as well, but in the context of sort of exits and trade sales, it's often the case that business owners, entrepreneurs decide they want to sell and set themselves a time frame, which is sort of a 6-month circa time frame, and that's about the duration of a typical trade sale process. So in effect, they are seeking to kick off a process as soon as they've decided they want to exit. And in reality, a preparation that could last 6 months or even 2 years prior to that is a far better way to set up a successful transaction, to optimize the value of the transaction, to ensure that the business is positioned appropriately for the best potential new owner of that business. So that, in my mind, that's one of the keys. I love to work with my clients 2 or 3 years before they're ready to exit, rather than 2 or 3 months before they're ready to exit. It allows me to add a lot more value to the overall process. The comment about doing capital raises themselves also applies to exits. So, there are a number of advisors who will compare their ability to sell their own business with engaging an external advisor. And sometimes the role of the corporate advisor is it's an amorphous one. It's sort of like a project manager across a lot of different areas. And And business owners will often understand the role that a lawyer might play in a transaction or the role that an accountant might play, but don't always fully understand a role that an experienced advisor might play in a transaction. So our advice is to our clients and our potential clients is always to engage with an advisor, because that is far more likely to increase the chances of a successful outcome.
So when you start working with a client, what are the sort of key things that you're thinking about? What are those critical aspects or critical steps that you're thinking about to take first with a client to at least start the foundations for that process in achieving a higher value?
Having the numbers of the business in order is just imperative. It drives so much of the ability to build a sort of a narrative around the potential sale or the sale process, and it goes to a large degree. It goes to some of the key issues that a potential buyer will look at. So having the financials in order is imperative, and sometimes that's in a sense as simple as fine-tuning the historical financials. But the reality is that if you give yourself 2 or 3 years to prepare for an exit, then getting the financials in order actually means getting the shape of the business in order so that you're positioning the business to match what a likely acquirer will look for. And that could be a stronger top-line revenue growth. It could be a shifting of the revenue from contract project-based revenue to contracted recurring AR type revenue. It could be a margin expansion over a couple of years. There's lots of ways to prepare the business to optimize for a transaction if you give yourself a couple of years. Getting systems and processes in order. I've seen clients replace their ERP or their accounting systems a couple of years prior to an exit so that they've got a strong financial platform on which they're building their business and from which they're selling it. So there's lots of activities like that surround the numbers, and then getting the story right, understanding where the business is likely to be sold, understanding who is the next natural owner of the business. Every entrepreneur and most business owners believe that they're the current best owner of that business, but understanding who is the next best owner of that business can be really evaluating in the process, because it allows you to either position your business in a way that's appropriate to appeal to them, or target them at the appropriate time. So a lot of that comes back to preparation, numbers, systems, strong bench, a strong management team, because if the entrepreneur is the leader of the business and they want to exit the business, then having a strong bench is critical. Otherwise, it'll mitigate against the valuation of the business. So yeah, some thoughts.
Perfect. And for you, Neil, you've obviously worked with a lot of companies going through the exit phase. What do you see as the sort of main operational challenges that companies or tech companies face during that exit process, and how can they be sort of proactively managed?
Well, in answering that question, I guess I'd qualify it by saying it does depend on the scale of the company. One observation I would make, I'm asked by many software companies, would like to sell, we think we're worth 3 to 4 times sales, because we've been looking at the comparables on the NASDAQ and perhaps haven't the interaction with or regular interaction with buyers. We don't realize that there's a massive discount for companies of below a certain size. So for example, with a software company, if you're below 5 million, you're not going to get anything like the kind of multiples that you're going to get if you're at 10 million, 20 million, 50 million. I mean, we do occasionally come across very extraordinary situations where you see this tiny company bought by Google for some fantastic number, but that's really the rarity. So coming back to your question of how do you prepare? Well, maybe I'll pick up on one thing which Rob mentioned, the word story. What is your story? What are you selling? So if you are a $5 million company, are you a $5 million company that's heading to $10 million? And you've got the elements of that story in place, which you can sell and therefore attract. Or are you a mature company? Well, there's nothing wrong with being a mature company. You just need to understand that's what you are and have a realistic expectation. If you are a mature company and you aren't wishing to put in the energy to take yourself forward, that's fine. But let's have a conversation fairly early on about your expectations of what you're likely to get. I guess a lot of my role as an advisor, certainly in the early days of the engagement, was shaking the chains of this future, which says, look, if we run out a process, this is how long it'll take. This is the work you have to do. And this is likely what you're going to get out of it. Now, I'm not the buyer. It's not my cash. But I can tell you pretty accurately the range of where your offers are going to come in to. And one of the important things I've learned through doing this many times, it's very important to have those conversations up front, because often business founders, if they've been working in the business a long time, their expectations on what the business is worth is sometimes emotionally driven around, well, what I want to do next is I want to do this and I need to pay off my mortgage, I need to do this. So it's kind of set from the internal. And if you go to a valuation company, you can get a technical valuation on your business. Well, that's great. But ultimately, when the M&A transaction, it comes down to what is the market prepared to pay. And
how much reliance does anyone play on those technical valuations that get done?
Depends on the context. I mean, in a divorce, perhaps that might be used in that situation. But if you're waving that around and expecting sellers to take notice of it, nothing, because it comes.
We've had that same in the capital raising area as well, where companies have got these technical valuations done. They're being told they're worth $50 and $100 million, and you're like, literally no investor will agree with you on that.
No, so it's kind of meaningless, and actually, what it signals, it's like putting a sign you say, "I'm not actually commercial." So that's usually not very helpful.
So you walk in the door, Neil. You're basically been engaged by a company. They've said to you, "Hey, we want to go through this sort of exit process." Like sort of Rob detailed what he's thinking about. What are you thinking about? What are the first three go-to things that you're thinking about for that company on the story, the positioning, the what you need to do, what you do successfully?
So I'm typically working backwards, which is when I'm meeting a company who says, look, I'm thinking to sell, I'm first thinking, who's going to buy this company? What's the audience? How do we... I'm really taking a product perspective, say the company is a product, and if we want a successful, competitive process, which will drive up the likely pricing to the upper end of the range for what this asset is worth, how are we going to reach that? So I'm thinking, firstly, I don't want to take on a company that I can't sell. So I'm firstly thinking, is it sellable at all? Then fairly early on, I'm thinking, who are we going to sell it to and how are we going to reach those kind of people?
And do you have in your mind like a framework of like, if I go to this kind of buyer, I think I can achieve this. If I go to a financial kind of buyer, I can achieve X?
I think most people who work in our field, and certainly Rob would be the same, if you're working in a particular sector and you're selling, you get the repeat experience, so you know what the software consolidators are paying, you know what private equity are paying, you know the kind of deals. So you have a fairly good idea of what market is because you've got that repetition.
And the curveball comes with a strategic buyer who has synergies. So a lot of the conversation today has been, what does the business do to prepare itself?
That's the dream for every founder, isn't it? It'd be the strategic buyer that's willing to pay more.
Who's willing to pay more because they're willing to pay away some of their synergies in order to to get the right outcome. And so sort of Neil's comment about understanding who the buyer is critical. A strategic buyer will typically pay higher than a financial buyer. Because a financial buyer is, in a sense, backing their own judgment to take that business and grow it from either additional or existing resources. But a strategic buyer should have some synergistic benefits, and if they're willing to pay away some of that, then the vendors might capture some of that upside.
How would you describe the types of buyers right now? You've just described financial, you've just described strategic. What are the other types of buyers there are of potential companies?
Well, if I may, it depends what people are buying.
So we're going free flowing now on that.
Let's
go.
So a financial PE buyer has a lifetime on their fund, and they need to basically buy well, grow it within 3 to 5 years, and exit it in order that they can continue to raise a fund. There are funds who are lifetime hold funds who are basically looking at basically building a portfolio of cash flows from fairly stable businesses that they intend to hold and monetize for a long time. There are strategic buyers who are looking just to add revenue, so it's like a protein buy, and you have capability buyers who are looking to buy to maybe fill a product's missing, maybe fill a gap in their technical stack, maybe something else. You have people who buy customer bases, who basically, do you remember the ISPs a few years back ago? I mean, everyone was just buying them because they just bought a customer base, and they had very standard metrics about how they do that. Now, my point being, as an advisor, you need to understand what people are buying in order that you can understand the value of the proposition to them. But one last point I'd make. When you're selling, it's not necessarily all about the price, because people sell for different reasons. And certainly in the tech space, sometimes it's not unusual to have a company that might have the kernel of what could be a really, really major business, but they don't have the resources, and they don't have the wherewithal in terms of management talent and skill to take that global. And it is one valid strategy to say, you know what, let's go and find a strategic partner and essentially sell yourself into that, which is you're taking on the project and a growth project, and you're looking to be taken up and supported by that. So it's a very different type of sale to a financial sale, which is about an individual exit.
And just quickly on that, sorry. A lot depends on the deal structure as well. So both a strategic buyer in a trade sale or a financial buyer like a private equity firm or a family office could structure deals where there's upside left for the vendor. So in a strategic acquisition, there's often
defined as an earnout.
And so on the strategic side, it could often be structured as an earnout. Yeah. Vendor might sell 70% today and 30%, 15% over the next 2 years, etc. But in a private equity transaction, it could be a majority purchase by the private equity firm, by the financial investor, but the vendor could maintain their equity stake and continue to run that through, maybe with an option to sell, or likely with an option to buy-sell option 1 or 2 years down the track. So it could be that transaction today is at a lower val or a lower valuation metric, but both parties believe that by working together, they can increase the val dramatically, and that therefore the vendor might effectively retain some of the equity and capture some of the upside along the way. So it's not just the valuation today that a vendor needs to think about, but it's the overall consideration.
So what you're both saying is effectively when you're structuring these deals, there's no really set rules. There's who is the seller, who is the buyer, and then there's flexibility around in which the final sort of deal is done, depending on who you're sort of targeting, who you're selling to.
Well, taking that further, if you understand the buyer, the deal structure tends to flow from that. So if you are private equity and you're not looking to run that business yourself, you're backing the founder. And so if you're a growth private equity fund, or even a buyout fund, and you're seeking to keep the founder motivated, you've got a structured deal that, to the points made previously, that you can say to the founder, look, you're doing okay on the first deal, happy you can pay off your mortgage and all the rest of it, but hang around and drive for growth, and you will make as much, if not more, on the final exit. And that's the story that's being worked together in that kind of exit. There are other sales where basically the person is just checked out and they want to hand over for car keys. It's a different construct and different deal structure typically that comes with that.
So this is for both of you. What are some of the common misconceptions founders have about the actual valuation process in the technology sector? Who wants to start? Look at them both jump.
Well, I'm just going to say delusional expectations is probably the thing. I'm not sure this is the right forum to kind of say that, because everyone...
Go for your life. That's why we're doing it.
And people show you your baby. Oh, what a lovely baby. One of the challenging...
My baby actually is cute.
Conversations up front is what's it actually worth? Well, in two things. That aspect of it is worth what someone will pay, pretty obviously. I see a big part of being an advisory is providing that feedback that says, look, yes, I'm not writing a check, but I can tell you pretty accurately what it is worth today. And to Rob's point, if it's a story that's still maturing, if you were to make these changes, what could it be worth? And maybe that is a catalyst to taking some decisions which perhaps have been put off. I mean, people do get comfortable in a situation. You grow up, you're paying yourself a reasonable salary, you may be running some money for your business. It's all pretty comfortable. And then you start thinking, I'd like to do something else. It takes time to put in place the structures. Maybe it's organization you need to bring in. If you are thinking that you are wishing to exit from the business, well, who's going to run the business? Have you actually developed the talent within the business you can run that? Have you built the processes? Have you got systems? Have you cleaned up the mess? Have you got rid of that boat which you bought for your company because that was seemed like a good idea at the time? All that kind of stuff.
Got it.
Just quickly on valuation expectations, the majority, the bulk of the work I do is in tech. The majority of the clients I have in tech are relatively high growth companies, and relatively high growth companies tend to sell on a high multiple because they've got relatively high top line growth, hopefully some bottom line growth as well. And it's a really tricky dynamic between a vendor, an entrepreneur, believing their business is worth 100 today, 100 units, getting an offer for and believing it'll be worth 200 next year, say, and getting an offer that's less than what they expect today because the purchaser doesn't want to pay away tomorrow's value to today's transaction. So there's this tendency for the entrepreneur, and appropriately, to believe that their business, that their baby is beautiful, that their business is highly valuable, particularly because they can see stuff that no one else can see, which is their vision of the future. So they know at the core of their heart, because they have to believe it, because they live it every day and they get up every morning and reaffirm to themselves that they believe that this business is growing at that rate, that they want to sell tomorrow's business at a valuation that's reflective of having achieved those outcomes today. And sometimes the buyer will accept that and actually pay extra today because of tomorrow's growth rate. But that's not always the case. And if there's a mismatch, then the entrepreneur goes, well, I'm not selling. I know it's worth 40 and they're only offering me 30. And so I'm going to hold it for another year and it'll be worth 50 and then I'll sell it. And sometimes they sell it for 50 and sometimes they sell it for 25, right? It depends on the market, timing, dynamics, demand, etc.
So if you guys are running a process and you're taking it to a larger corporate, right, a potential sort of corporate buyer or a larger sort of listed company, what have you found have been some of the negotiation sort of strategies or tactics which have, I suppose, either set the foundations or created the pathway to achieve a higher valued exit?
Well, I'll take a crack at that first. I mean, first, it's important to realize if your revenue is, let's say, only $2 or $3 million, you may not get the interest of the corporate buyers to even respond. So it's not infrequent with a relatively small company to get through to the corporate development people, and they'll just say, look, it's not worth my time to do the transaction by the time I've paid my lawyers and all the rest of it. And by the way, that corporate development guy has probably got a bonus tied to maybe acquiring $100 million worth of revenue each year. And so you're just not, they might be, look, it's a really interesting company, come back really bigger. So you're not even going to get the audience there. So coming back to the thing of what can you do to increase your value? I'll come back to the story aspect. Have you actually thought through what this company can do for that particular organization? So the way the process will work inside the corporate is that somebody, and it's usually the corp dev team, will put together a presentation that they take to the board, which is the rationale of why we should acquire this business, how it's going to fit, how it's going to work and integrate with the organization. Now, if you're smart, you try and, through intelligence and speaking to these guys, work out what those slides need to look like and you write them for them, because everyone's busy. So if you can put it on or maybe repoint, a big corporate buyer will have a list of maybe 100 targets that it's looking at any one time, which are being shuffled for priority of whether to get money or attention. And it's if you can make yourself easier to buy, which is look attractive, you've got rid of the hairs of the dog, so you've cleaned up anything which would make it a tricky transaction, and you've written a story for them, and you've presented that story in an easy to digest form, you're going to more likely to get to the top of the stack. And the simple name of the game is that you want to be on the top of the stack for 2 or 3 people, and then you're going to drive a higher valuation.
Just on the point of negotiation, one of the things that I'm sure Neil as well, one of the things that we focus on is trying to run a competitive process when we're managing an exit process. And if the parties involved know that it's competitive, and they'll know that because they'll understand they're in a process and there's timelines that have been set, and they'll know that there's structures put in place to manage multiple parties going through a process like data rooms, etc. If they know that they're in a competitive process, even after they've made an offer and even after that offer's been accepted, they'll be aware that they still need to, if you're then progressing through into the more detailed due diligence, etc., they'll still be aware that they've put forward an offer that's been accepted in context of a competitive process. And setting up that frame is really important for the negotiation, both for the term sheet, for the initial offer, as well as subsequent negotiations over the detailed transaction. I talk about a 2 or a 10-page term sheet going to a 200-page legal document, and that transition involves a lot of negotiation. So understanding that the counterparty understanding that they're in a competitive process throughout is really important. Otherwise, the power shifts to the buyer, because they're the ones with the checkbook, rather than the seller, who sort of have to, in a sense, accept what they're being offered. But fundamentally, from a negotiation point of view, my view is that the better the preparation, the more likely it is that me, as my client's advisor and their appointed expert negotiator for this transaction, the more likely it is that I can negotiate a quality outcome, because I'll understand the underlying context of the business that I'm trying to improve the valuation of, or the terms associated with the deal. But in that preparation phase, we also try to understand who the buyer is specifically. So if the buyer is, let's say, Origin Energy, for example, who was a now announced buyer of a former client of mine, understanding who their corp dev guy is, understanding what transactions they've done recently, understanding the methodology that they deploy, whether or not they structure deals, etc., having that knowledge, or at least understanding their strategy and understanding what's important to them, all contributes to negotiating a sort of a win-win outcome. So
the for the final sort of 4 minutes and 7 seconds, what are some of the trends that you guys have observed over the last sort of, like, the last 2 years have been tough from an innovation perspective, but I'd love to know what are some of the things that you have observed from the buyer side as far as their appetite, what they're looking at, how they're thinking about sort of structuring deals, what options they have, etc., or who's most active in the market, etc. What's your sort of observation?
I'll have first crack at that. So from my perspective, in the last kind of 5 years, the big shift in terms of software companies has been the emergence of private equity as a major buyer of software companies. So we're seeing probably about 50% of transactions in the software space being private equity, and often that might be at the first stage, or it might be private equity selling to private equity. Second, it's the emergence of software consolidators. So people may in this room be aware of a Canadian company called Constellation Software.
We have talked about them a fair bit this year.
Yeah, okay. So Constellation now, I think, has about 20 different business units looking at different verticals. It's been around long enough that the early employees of Constellation have now gone out and raised their own funds. So there's probably in Australia operating now about 12 to 15 software consolidators with different strategies looking after different things. So you've got this emergence of these evergreen buyers looking for software companies. And so now when we're running a process, there's always a section for, okay, we're going to be talking to consolidators, which PE firms are we going to go to, and which strategics are we going to go to?
In the broader tech landscape, about 2 or 3 years ago, valuations in the US were super high, at a relative high, a sort of 5-year cycle high.
The good old days of 2021 and early 2022.
Yeah. Sort of post-COVID, the valuations went up. Listed tech companies, private tech companies, transaction multiples for B2B SaaS companies were through the roof. Companies were being priced at significant revenue multiples, let alone earnings multiples, etc. When that changed in the US, a few seconds later, it changed in Australia. So the impact of that for a year or so was that vendors still had high expectations, but acquirers and investors for capital raising moderated their valuation expectations according to the market. Everything else became cheaper, therefore private equities became, have to become cheaper as well. So listed companies and private companies. But in the last year or two, and venture capital funds and family offices and even high net worth individuals sort of held back on their investments, kept their cash, because as long as there's some volatility in the market, cash is more valuable than when there's capital abundance. In the last year or two, more funds have raised capital, more investors have come out, both as strategic acquirers and as investors. And there just seems to be more green shoots in the market now at the capital raise investment level, but also at the M&A level. So I think that the last couple of years we've seen sort of the peak and maybe not the trough, but certainly coming out through into a new part of the cycle. And that's sort of exciting for us in sort of M&A advisory land, because there are transactions that will happen and there's more demand for good quality assets, and vendors have got more realistic expectations around pricing, etc. So.
Brilliant. And in the final time, I'll just say that from our side, the observation from me, and I mentioned this morning, is a lot of the people that I've known from the venture and innovation space are now looking to basically either create opportunities or get more involved in the business exit space as well. So that's been interesting from my side. And you can even see, and the nice thing from our side, it's sort of one and part of the same ecosystem. I know a lot of you guys are involved with companies that are either thinking about an exit process or going through an exit process. So just on a fishing note, I just want to say a big thank you to you guys. Just so you know, we literally got through 1/3 of our questions. So we literally could have gone for an hour and a half. Thank you so much, guys. I'd love to do this again with you another time. That was a really, really good. We didn't even get on topics about, integrate, stakeholder management, going through the exit process, etc., post-transition, all that stuff we wanted to cover. But hopefully we can do it another time in another session. Thank you so much.
Thank you.